Good afternoon. I'm Rick Edelman. Thanks so much for joining us for this very urgent, topical, timely webinar. What you need to know about the Ethereum futures ETFs. These are brand new, as you know. They just came onto the market this week and actually today. And we're very excited to be presenting you with this content, this information on the latest developments in the field of crypto. And joining us on this program today, I'm very happy to welcome my good friend, Matt Hougan. Matt is the Chief Investment Officer of Bitwise Asset Management, traveling in New York City today. Matt, thanks for joining us.
Thanks for having me, Rick. Delighted to be here for this timely webinar.
Matt has been in not only the crypto field for the past decade or so, he's been in the financial services industry for decades, where he was the CEO of Inside ETFs, which was, as I'm sure you know, the largest ETF-focused conference in our industry. Thousands of people attending that event still every year. And Matt, you've now jumped ship going from the ETF world to the crypto world, and with the development of Ethereum futures ETFs, you're frankly doing both right now.
That's right. It's like when you go to a party and your college friends and work friends show up. It's the crossing of my world, Rick, but I'm really excited about what it means for crypto and for investors, and I'm sure we'll discuss.
As certainly we will. But as a prelude to it, do us a favor, Matt, and tell us a little bit about Bitwise.
Sure. So Bitwise is a specialist crypto asset manager. Crypto is all that we do. We are the largest crypto index fund manager in America. And we've been managing assets on behalf of investors since 2017. We're known for a few things in the industry. A few things set us apart from many of our peers. One is that we're primarily focused on the financial advisor and RIA market. We serve today nearly 2,000 firms and financial professionals in that space, and we've built our business to serve that market. We're also well known beyond just developing the first crypto index fund and the first crypto equity ETF for doing significant research. So I was fortunate enough to co-author the CFA's Guide to Crypto. And as a fun fact, Rick, I also co-authored their Guide to ETFs back in 2015. So this really is the crossing of my two worlds.
Bitwise is also unique in that you have a dedicated team of support to advisors that I think that's unique in the crypto world.
I think it's the only one. They're available in every geography in the US, and they exist to be your ears, your information, your source of truth for the crypto market. We know that when advisors buy a product, it's not just a point of sale transaction. It's just as important what you do as a firm to support the advisor after they buy that product as before they buy that product. So we have this entire team. They are there if you get a call from a client. What does this mean? What does this new development mean for the crypto industry, for my investment? Our team is ready to answer those questions. That's how we built our firm. And you can click that link and reach out to your local representative, and they would love to discuss crypto and crypto allocations with you.
And we will place that link in the chat so you can easily access it to find out which of these team members are in your local region. So thank you for that, Matt. Let me jump into the conversation we're going to have today. But I'm a little concerned that there may be some folks watching this webinar who aren't fully immersed in crypto and may not really, frankly, Matt, know the difference between Bitcoin and Ethereum. So let's start there for a moment at the very basics. And by the way, if you have questions, many of you did send in your questions in advance when you registered. If you have questions, type them into the Q&A box. I'll be checking that throughout this event and peppering them in throughout our conversation with Matt. But Matt, start off with Bitcoin and Ethereum are the Coke and Pepsi of crypto. They have, what, between the two of them, 70% of the market share of all of crypto. So talk about why Ethereum. What's the difference between Ethereum and Bitcoin?
It's a great question, Rick. I'm glad we're starting there because Ethereum is very different from Bitcoin. The way I like to talk about this is to remind people that every crypto asset has two things. It has the asset and the underlying blockchain. So as you know, Rick, there's Bitcoin, the asset, which exists on the Bitcoin, the blockchain. There's Ethereum, the asset, which exists on Ethereum, the blockchain. And those underlying blockchains are just pieces of software. And like any piece of software, they can be optimized to be good at one thing or the other. So in the case of Bitcoin, it was a revolutionary breakthrough when it was imagined in 2008 and 2009. It created for the first time ever the ability to store wealth without a bank, to send money anywhere in the world in a matter of minutes. Revolutionary breakthrough. But it's actually a limited programming tool. The Bitcoin blockchain can only do a few things. It can hold wealth, send wealth, store wealth. That's about it. The developers of Ethereum in 2015 looked at Bitcoin and said, it's amazing that you can move $1 billion anywhere in the world in a matter of minutes, faster than JP Morgan or Goldman Sachs. What if we could program this the way we program software? So the Ethereum blockchain took everything that Bitcoin did and add programmability. So if you want to build a decentralized version of the New York Stock Exchange, you can do that on Ethereum. If you want to build a decentralized version of an investment banker, you can build that on Ethereum. If you want to program money, you can do that on Ethereum. And that's why today, many of the most popular applications in crypto, stablecoins, DeFi, NFTs, are all built on Ethereum. Now, I should say that doesn't mean Ethereum is better than Bitcoin. It just means that it's different. When you're designing software, if you have limited programming capability, it makes your software more secure. You can think that Bitcoin is a much simpler software program. And if you're building digital gold, that's all you care about. Ethereum will never compete with Bitcoin for the digital gold market. But if you're trying to build a new internet for decentralized finance, for decentralized digital property rights, you can't do that on Bitcoin. You can do it on Ethereum. And that's why you're seeing things like today, UBS announced a tokenization program to tokenize bonds built on Ethereum. So they're very different assets, very different use cases. It's not gold to silver. It's more like gold to Microsoft. I love them both, but excited to talk about Ethereum today.
And in fact, you have called Ethereum the world's most exciting crypto asset because of that feature, the fact that major companies are all building applications on Ethereum. Nike, Starbucks, Adidas, Pepsi, PayPal, JP Morgan, the list goes on and on and on. And stablecoins tend to use Ethereum as well, which now have, what, $1 trillion in transactions quarterly at this point?
Yeah, more than MasterCard, more than PayPal, almost as much as Visa. Yeah, Ethereum, if you're looking in crypto for where the real world applications are being built, they're being built on Ethereum. And that's why I think it's the most interesting asset in crypto. I also think it's going after the largest market, largest addressable market in crypto. And don't get me wrong, I think Bitcoin is going after a large addressable market. The gold market is $12 trillion. That could justify a Bitcoin price of $500,000 a coin. But Ethereum is looking to rewire the fundamentals of how bonds settle, of how real estate settles, of how money moves around the world, of how we handle digital property rights. And that's an even bigger market. So it is a very exciting opportunity and a very different opportunity. And I think they're going to have very different return patterns in the future. So investors should consider both.
There's also a difference in the underlying economics. Ethereum is different from most other crypto assets because of the fee that people pay to use it. So describe that for us.
That's right. If you've been frustrated with crypto because there are no cash flows, well, let me introduce you to Ethereum because there are explicitly cash flows. You mentioned it. If you have an application built on Ethereum, let's say you have a stable coin or you're issuing an NFT or you're building a smart contract or you're just sending money, if you want to use the Ethereum blockchain, use the Ethereum supercomputer, if you want to use that word, you have to pay a fee in ETH. And the fee, when you pay it, is destroyed. Now, this gets people confused, so let me just back up a little bit. Today, there are about 120 million Ethereum in existence. That's it. That's all there is. And every year, about 1% more Ethereum gets produced. But as people use the Ethereum blockchain, Ethereum also gets consumed. And right now, about 1.5% of Ethereum is consumed every year. And that means that the total amount of Ethereum in the world, that 120 million, is actually going down over time. It's kind of like a stock buyback. You know, a company generates revenue and they use that revenue to buy back their stock, which makes the other shares more valuable. The Ethereum blockchain generates revenue and it uses that revenue to remove Ethereum from circulation, to destroy it, to reduce that count, which makes the rest of Ethereum more valuable. And I think this is a real big difference. It's one of the reasons I find Ethereum makes more sense to traditional investors than Bitcoin, because it has cash flow. You can do traditional valuation metrics. You could assign it a PE. if you wanted to walk through that valuation exercise. And it's a really important difference.
And solves, I think, the fundamental objection that Warren Buffett and Jamie Dimon and others have when they claim that crypto has no intrinsic value. That's an argument they've made against Bitcoin. Harder for them to make that argument against Ethereum.
Yeah, they can't make it. If they took the time to understand that Ethereum was this different from Bitcoin, they would understand it does have revenue-like characteristics, cash flow driven valuation metrics, price to earnings and price to sales multiples, all the things we're familiar with from our traditional stock analysis in a version you can apply into the Ethereum space. And that makes it a really exciting investment.
Which means that you can now even look to crypto if you're an income-oriented investor because of those cash flows.
That's actually right. And we didn't even cover the other piece, which is if you own Ethereum and stake it, you can earn a yield, almost a dividend-like payment. So yeah, we need to get away from the world where crypto is one thing. It's not. It's a technology. And just like, the internet is not just one thing. It's not just the New York Times. It's a bunch of different things. It's Zoom. It's this webinar that we're doing. Crypto is a technology, and it's not just digital gold. It's also a platform for creators. It's a platform for finance. It's a platform for payments. It's a platform for applications we don't even know about. And we're starting to give people the tools with these new ETFs to decide where in crypto they want to allocate.
Now, one of the exciting elements of crypto is everything you just said, that, wow, this all sounds really cool. Love to get in on this, so to speak. The challenge facing financial advisors over the past decade, 13, 14 years now in Bitcoin's existence, Ethereum, a little more than half that, is that it hasn't been terribly easy to access, especially for financial advisors who are dealing with their compliance departments, who have frankly said no to crypto because of regulatory uncertainty, as well as sustainability of the asset, and just a lot of different questions that arise from market competition to the investment thesis to market demand to you name it. And there hasn't been a very easy, convenient way for advisors to buy digital assets historically. And this is why the market, I think, Matt, you would agree, has largely been limited to the early adapters, those willing to engage in the frontier, who are willing to take excessive risks and go through a rather cumbersome, complex, and often intimidating process to acquire their crypto. What we've all been wanting and waiting for are ETFs, and I don't have to champion ETFs to you of all people as to the benefits, but we understand why ETFs are the most popular investment vehicle in the country. They're affordable, they're transparent, they're highly liquid, they're incredibly easy to build portfolios with and to manage them with rebalancing and dollar cost averaging and tax loss harvesting. What's not to love? But that platform hasn't been around in the crypto world. But now they are. We've had for the past couple of years a Bitcoin futures ETF. And now this week, we now have an Ethereum futures ETF. So I need you to explain to us these concepts. We're then going to talk specifically about the ETFs that Bitwise has made available, because you've got first of their kind products that you've just launched. But talk generally speaking about these futures ETFs, because they are not the same as ordinary ETFs that I think most advisors are generally familiar with.
Yeah, that's exactly right. Great lead up, Rick. I agree with all of it. Excited to talk about Bitwise's products, but to talk generally, the SEC has been unwilling to allow us to have a spot Bitcoin or spot Ethereum ETF to this point. There are a variety of reasons. We can get into those if you want. But what has happened is this regulated futures market has been established by the CME that trades billions of dollars every day, covering Bitcoin and Ethereum. And this is a market where traditional financial firms and institutional investors are using these futures to gain exposure to Bitcoin and to Ethereum because they can't invest through an app, right? A large institutional investor is not going to pull out their phone and download an app and put $1 billion to work. They're going to work in a regulated market. Right. What these ETFs do is they take those futures and package them up into a ticker that's accessible to everyday investors, financial advisors in a brokerage account. Because we recognize that for many advisors, what are you talking, Rick? A 1 to 5% allocation to crypto at most.
Right.
It can't be hard.
Right.
It can't require extra paperwork, extra time, extra risk. You can't be worried about, even if you were going to operate in futures, rolling your futures exposure. So the ETF takes care of all that. It holds 100% Ethereum futures in the case of the ETH only. We also have a blended product that's 50% Bitcoin, 50% Ethereum. And then you get returns that are 0.99 or so correlated to the underlying spot market in a ticker you can buy in your brokerage account. It's a pretty phenomenal story.
And it takes the complex and makes it very simple. And that, we all love ETFs. And so, we don't have to reculturalize our client. We don't have to retrain our staff. We don't have to introduce a new tech to our practice. It's simple and easy. It's just another ETF. Just like you've got an ETF that buys gold, or an ETF that buys oil, or an ETF that buys emerging markets. Now you have an ETF that buys ETH or buys Bitcoin. But it's buying the futures contract of these rather than the exact asset of these. So talk about that element, Matt. Talk about the fact that this is a futures contract, because you just mentioned a moment ago, and I want you to elaborate on this, the correlation. If I want exposure to Bitcoin or exposure to Ethereum, I want my exposure to be as literate, as direct as it can possibly be. You just said that the correlation is very strong between a Ethereum futures ETF and Ethereum itself. Elaborate on that.
Yeah, it is very strong, but it's not spot Ethereum. So the way the futures market works, of course, is that you have an underlying commodity like Ether, and then you have an exchange that offers the right to buy that commodity at some point in the future. Usually it's every month. So you could buy it at the end of October or the end of November or the end of December. And that price at which you buy it in the future may be slightly above or slightly below the existing spot price. They have fancy words for this in commodity land. They call it contango if it's above, and backwardation or below. But all you have to remember is you're buying it in the future, like the name suggests. And so the price will be a little bit different. What these products do is that they take investors' money and they use it to allocate to the next available contract. So let's say the contract expiring in October, and then before it expires, they roll it over to November, and then they roll it over to December, and so on and so forth. So you get continual exposure. If you look historically, these have tended to have a very high correlation to the spot price, about 0.99. They can trail the price to a small degree because there can be contango in the market where the futures are priced slightly higher, but they might actually outperform in certain markets, because one of the beauties of futures is that you don't have to put all your money up. So what these funds do is they take the collateral and invest in treasuries and earn what's right now about a 5+% yield on those treasuries. Now that all sounds complex, and there's a whole team in the office behind me that worries about rolling futures and evaluating the curve and investing in treasuries, those sorts of things. What an investor needs to remember is that these are highly correlated to the returns. Now, do I think people would prefer spot? Many people would prefer spot. But Rick, you remember the first Bitcoin ETF was filed in 2013 when Bitcoin was trading at $80, $90. If you've been waiting for that spot Bitcoin ETF, well, you've let the perfect be the enemy of the good enough. And I think there are many investors who want exposure today, maybe ahead of what is hopefully the eventual approval of spot ETFs. And these ETFs are great tools for that.
You raise an interesting point that this is better than nothing. And that's as pejorative a way as we could phrase it, right? We don't have the Holy Grail. We do not have the spot product. There's no spot Bitcoin ETF. And since we don't even have that, I don't even want to begin to guess when we'll have a spot Ethereum ETF. But we do have the futures ETFs. So it's better than nothing. You might as well do that. But let me just fast forward with you, Matt, theoretically. Let's assume that one day we do get the spot products.
Mm-hmm.
That means both are on the market. You now have, in my fancy world, you've got a spot Bitcoin ETF as well as the Bitcoin futures ETF.
Mm-hmm.
Which of the two should you own?
I think the majority of investors will go with the spot ETF. That's what we see in the gold market, where the majority of investors own spot bullion. Now, there's actually an argument for some subset of investors who will be better served by futures. Those are investors for whom the tax consequences may be better, or for whom the interest income, that sort of push that you're getting from the collateral investment, means it actually may, in certain high interest rate environments, outperform the spot market. But I would expect most of the money to move into the spot. That's the natural state of things in the ETF world. But as you mentioned, that could be a few months, it could be a few years. People have been waiting for Godot for a long time in ETF land. And in the meantime, these are great tools, and they'll still be great tools even when spot products exist.
And Tom, in fact, has asked a related question to that. What he wants to know what your thoughts are that we'll see a Bitcoin spot ETF approved in the next 6 months.
Yeah, I'm really optimistic. I think within the next 6 months is a great time frame. It may even be on the inside side of that. I think there's a lot of things you can point to in the spot Bitcoin race that are positive. I'd highlight three, Rick. We had the Grayscale lawsuit where Grayscale won against the SEC. The judge found that you can't approve a futures ETF and deny a spot ETF on the same grounds because they're so similar, right? That actually speaks to how similar they are. We have firms like BlackRock coming in and doing surveillance agreements with Coinbase. And at Bitwise, we recently submitted 40 pages of academic research to the SEC, answering point by point their concerns that have been blocking them from having a spot ETF. That's a lot of high quality pressure from high quality firms. It makes me optimistic, but there's no guarantee. So if I had to put money on it, I would think it's going to happen, but there is no guarantee.
I find it rather infuriating that and confounding that the SEC has continued to say no. They've literally, tell me if you like my analogy, they have, in my view, said that you can eat ketchup, but you can't eat tomatoes.
I love it, Rick. I love it.
How can you say yes to the futures contract, but not to the underlying security on which the futures are derived? It makes no sense.
I've never heard that one, but it's pretty good.
All right, let's talk about the specific products that Bitwise has created, because this, I think, will make it more tangible for advisors in the evaluation of whether or not these are worthy of consideration for clients. You've just introduced two, count them two, futures ETFs this week, AETH and BTOP. These are, you're calling them first of their kind. Let's talk about them one at a time. The AETH, is that the short name you're giving it, or AETH?
AETH, it's a pretty cute ticker, right?
I love it. AETH, the Bitwise Ethereum Strategy ETF. Explain how it works.
That's right. This one's really simple. It invests 100% of its non-cash assets in CME regulated Ethereum futures, and it rolls them every month. And then it takes the cash collateral and invests that in short-term treasuries and cash-like instruments. And so this is a fund that gives you just 100% exposure to Ethereum-linked returns. And it was among the first Ethereum-linked ETFs to launch in the US. We're very excited about it.
The big issue in crypto is custody.
Mm-hmm.
It's risky enough to buy crypto, but where are we holding it? So where are you holding your crypto that you're buying, or in this case, the futures contracts? Who's the custodian of this fund?
It's the beautiful thing. You don't have quite the same issue because you're just holding regulated futures contracts. So BNY Mellon, firm you may have heard of, Rick, the oldest bank in America, is the custodian for our cash and for the assets in this fund.
Bank of New York, of course, founded by Alexander Hamilton. What's the expense ratio of the fund?
The expense ratio is 0.85. That's the lowest expense ratio for the open-end Ethereum ETFs that exist on the market today for the classic structure.
And I'm glad you highlighted that it is the lowest cost. There are others that are charging more than that. We know that ETFs, one of the big claim to fame is that they're low cost. 85 basis points is on the higher end of ETF prices these days. So elaborate on why the expense ratio not just is at 85 bips, and in fact is the lowest of everybody in this space. So why that price?
Yeah, and I should clarify, there are open-end funds and there's one C Corp fund. So I was talking about the open-end funds. Why that price? The crypto market is complex. Futures are a complex market. We tried to make it the most reasonable price while still providing high quality service. We're excited that we're at the lower end of the spectrum. But this is in line with other futures-based ETFs that you see. The reality is this market's just a little bit more costly than spot. I'd expect spot to come in a little bit cheaper than this, but this is a high quality product at a reasonable price.
And I think it's pretty much in line with all the what I'll call exotic investments. If you look at emerging markets funds, you look at commodities funds, I mean, these things it's more expensive to buy the underlying asset than just the S&P 500. It's not a commodity the way they are. So the fact that it came in below a point, I thought was impressive. So I don't think that anybody should be surprised at 85 bips.
Thank you.
Let's shift now to the second fund you've created, BTOP, the Bitwise Bitcoin and Ether equal weight strategy ETF. I think this is pretty interesting.
Yeah, we're really excited about this one. It's like an easy button for your crypto exposure. It holds 50% Bitcoin futures, 50% Ethereum futures. Those are the two largest assets in crypto. Together, as you said at the start, they represent nearly 70% of the entire market. And then it rebalances every quarter. So you have exposure to the majority of the market, the two biggest use cases, right? Digital money and this smart contract computing platform. And you can just make that allocation and sit back and have checked the crypto bucket for your client. Now, if you want to get specific, you could overweight with AE. We also have a Bitcoin futures ETF, BITC. You could overweight with BITC, or maybe you like one or not the other. We're trying to give advisors tools. This is like the starting point, BTOP. This is the neutral portfolio, 50-50, but you can overweight, underweight, or just allocate to one or the other with this trio of tickers, AE, BITC, BTOP.
Yeah, you used a phrase there that I really like, just check the box. And I think that's really where crypto is. Over the past, dozen years, I have seen the industry go from incredulence to disbelief to skepticism to dismissal to acquiescence and eventually where we are today, where most advisors are done fighting the fight about crypto. We're done arguing. Is it a fad? Is it a fraud? We're done arguing. Is it here to stay? I think everybody is kind of shrugging their shoulders saying, okay, I may not love it. I may not get it, but I can no longer deny it. And my clients are asking about it. It's ever present in the media. There's no reason. If I'm telling my client I believe in a diversified portfolio, why am I not adding this to that diversification list? Since especially the correlation numbers are so much in the favor of adding this. So instead of arguing about it, why don't we just, as you said, check the box? And the real question then becomes, how do I check the box conveniently and easily? Well, now we solve it with an ETF. And second is, which box am I checking? The big debate, Bitcoin versus Ethereum. There are 20,000 coins now. Is that right?
That's right. Something like that.
Which is an absurd number. But these two by themselves have 60, 70, 80% of the market. So just buy Coke and Pepsi. You can buy RC Cola if you want, or Mountain Dew and Dr. Pepper, but why bother? Just check the box. And you've now created an ETF that has both of them 50-50. So we don't have to get into the argument over which one's better, which one should I do, when should I do it, how do I do it? Just check the box. It's a low single-digit allocation. Add it to the client portfolio. Tell them you're maintaining broad-based global diversification in every asset class. Check the box. I mean, that's a great way I think you can phrase it.
Yeah, I love it. That's exactly right. And you can use it to have conversations with clients. Many of them already have crypto already. They'll be appreciative of you coming to them. And it's a regulated ETF that fits in your compliance reporting software. You can charge fee on it. If that's how you operate. It's an easy solution, and we're really excited that it's now live.
So David is asking a question, and before I tell you what his question is, I want to preface it with a statistic that was just released last week by Coinbase. Coinbase said that 53 million Americans, or was it 52 million, one or the other, own Bitcoin. That's more than directly owned stocks, about twice as many as directly owned stocks. A little bit of a cheat because so many own it indirectly through ETFs and mutual funds, through their 401k, et cetera. But with 53 million Americans owning crypto, odds are pretty good your clients are among that list. And they didn't get it from you because you wouldn't help them. Your firm wouldn't let you. You didn't know how to do it or whatever. So they went and got it on their own. This relates to David's question. If an investor owns Bitcoin currently, is there an argument to sell it and buy these ETFs?
Well, it depends. It's a great question. I think it depends in part upon the tax situation. Are they up on their position? Are they down on their position? And then it depends on your personal preference. How important is it to bring it into the advisor relationship? I would argue it's really important. People ask me what the biggest risk in crypto is, and I always say it's not regulatory, it's not technology, it's not volatility, it's behavioral risk. The biggest risk in crypto is selling when the market's down and buying when it's at its peak, because this is one of the most volatile markets that investors can get exposure to. So I think it's great to bring it in to a portfolio. But if the tax overhang is significant, you need to look at another way to do that. So for many people, if they have clients with large amounts of Bitcoin, they need to work with a provider, and Bitwise does this, who has SMA offerings and can bring them into an advised a relationship without that tax consequence. So I would think about that taxable element, but otherwise, great. Let's get them into an advised relationship where it can be part of an overall portfolio allocation, where you can have sort of behavioral guardrails to prevent against, excessive responses. And then I think both you and the client will be better off.
And I think, to your point, Matt, this creates a huge and wonderful planning opportunity for the advisor to demonstrate value to the client, to be able to say to the client, to just imagine sending an email to all of your clients saying, do you own crypto? Have you bought Bitcoin or Ethereum or some other digital asset? Are you aware that these new ETFs have now become available? We should talk about whether or not you should buy these in addition to your current holdings or use them as an alternative replacement of your current holdings. Let's evaluate the custody, the taxes. Let's also talk about the integration of the asset into your portfolio that I manage for you, or from a rebalancing perspective, a tax record keeping perspective, and a safety of custody and cost perspective. This is a wonderful opportunity for you to demonstrate to your client that you know all about this stuff, that you're able to help them in ways that you haven't been able to help them in the past, to be able to give them information that they're unaware of on their own. So I think this is a tremendous opportunity for advisors to demonstrate value to their clients that, frankly, a lot of advisors have been struggling to do, to differentiate, to explain to their client why they should continue letting you be their advisor, given what's going on in the marketplace. So I wouldn't take that lightly. I think this is a big opportunity.
Yeah, love that.
We had one of our advisors watching asked us to post in the chat the link to the two funds, A ETH and B Top. We have done that. So if you go to the chat button, you will see the link directly to the Bitwise site to do that for you. You noted, we just emphasized heavily, Matt, this whole check the box thing, but you also said that this is a starting point. You're not trying to dictate or even recommend how an advisor allocates to crypto. Bitwise, in fact, offers a wide variety of funds. You've got BITQ, BITC, BWeb, BITW, private placements, multi-strategy solutions. You have SMAs. You're kind of all over the place. You're the most prolific producer of crypto investments of anybody in the industry. I think it might be worthwhile just to spend a couple of minutes. Give me a one or two sentences for each one of these to help advisors realize the availability of what's out there. Let's start with BITQ.
Sure. BITQ is the first crypto equity ETF to hit the market, the first ETF that could ever use crypto in its name. And the SEC doesn't let you use that unless you have pure play exposure. So that's a picks and shovels ETF. It holds Bitcoin miners. It holds companies like Coinbase. These are the companies building the infrastructure behind crypto. It's a little bit like owning gold miners as a way of owning gold. If you're more comfortable in the equity market, BITQ, one of our fastest growing ETFs, gives you pure play exposure to that market.
So in other words, it's a stock fund, just like every other stock fund, and it simply limits its investments to stocks that are in the crypto industry one way or another.
That's exactly right. And it has a correlation between about 0.5, 0.8 to the underlying crypto market. So a close correlation, but it's just stocks, right? No crypto at all, not direct crypto exposure. And some compliance departments like the idea of only owning stocks that have balance sheets and earnings and profits and things like that. So that ETF BITQ is a great solution for that.
So when you have a client who says, I don't want to own crypto, you say, great, you're not owning crypto. You're owning IBM, which has a big blockchain division. You're owning Coinbase and other companies that you've described. So yeah, it's a very effective way to gain exposure to the market without actually owning crypto.
That's right.
BITC.
Yeah, BITC is like AETH. So AETH, the product we launched this week, is 100% Ethereum futures. BITC is 100% Bitcoin futures. So again, it's this toolbox approach, Rick, where we're trying to build the highest quality tools to give you the exposures you want. We have that easy button with BTOP, but if you have a specific view on Bitcoin, BITC gives that to you in a regulated ETF package, high correlations, professionally managed, and we're pretty proud of that fund.
Crypto is the big thing, has been for a while. Some argue that the next big thing or the new big thing now is tokenization. And some argue that the next big thing is the metaverse. Talk about BWeb.
Yeah, absolutely. The way I think of BWeb is it's big companies that recognize what's coming in terms of crypto and blockchain and the metaverse and are building to that future. So as an example, PayPal is, of course, an enormous fintech company with a large business, but they see what's coming. And that's why they recently launched a stable coin built on the Ethereum ecosystem, because they think it can accelerate their payments. And that, in our view, means PayPal will succeed where its competitors fail because they are not moving ahead. So what BWeb does is it captures the companies that are using crypto and blockchain to accelerate their business. I'll give you another analogy, Rick, because I know you like analogies. If you think about something like steel, you could invest in physical steel, you could invest in steel manufacturers, or you could invest in automobile makers that use steel. The same thing's true in crypto. You could invest in Bitcoin, BITC. You could invest in Bitcoin miners and other companies, BITQ, or you could invest in the companies that are using Bitcoin, blockchain, and crypto to accelerate their business. That's BWeb. And so that stack is what we offer to investors.
I do like that analogy. That's a good description of the distinction between them. And then finally, I think you've got what I think is the big boy of the category, BITW, the Bitwise 10 Crypto Index Fund.
I love this. This is in the vein of BTOP, but it was the first and is today the largest crypto index fund in America. It holds the 10 largest assets, screened for risks. So there's no Dogecoin, there's no Shibu, there's no Binance in there. It's only assets that we think are appropriate to institutional investors that have passed our screens, and then it rebalances every month. It's like the S&P 500 of crypto. Now that is available as a ticker, but it is not an ETF. Important to disclose that. It trades as an OTCQX traded trust, which means in shorthand, it trades kind of like a closed-end fund, can trade to big premiums or discounts. You need to recognize that those can exist and they're beyond our control. But it does give you broad-based exposure to the 10 leading crypto assets. And it's been a very popular fund with investors.
And for high net worth clients, you've got private placement funds, multi-strategy solutions. Talk about, though, your SMAs, your separately managed accounts, in conjunction with Eaglebrook Advisors.
Yeah, absolutely. We love Eaglebrook, a phenomenal firm. As I mentioned earlier, there are many clients, many advisors have clients who have significant crypto holdings that want to bring them inside of the practice. An SMA solution lets you do that. So we have a variety of strategies within the SMA, whether it's an index approach, whether it's a sort of best ideas portfolio or an equal weight strategy. And advisors can use that to onboard those assets. It's also the case that some advisors have built their practice around SMAs. And if that's how you built your practice and that's how you handle stocks or ETFs, why not handle crypto the exact same way? Again, what Bitwise does is try to provide best-in-class solutions in a variety of wrappers. So however you manage your practice, ETFs, private funds, alpha strategies, SMAs, there's a solution that plugs in. You don't have to think about the plumbing You just have to make the decision to make an allocation to crypto, and we'll help you find the right vehicle to do that.
So as you can clearly see, Bitwise offers a wide variety of product that allows you to customize the allocation you want to create for your client, depending on how you want to approach the marketplace. And they have a broad array of talent on their team who are ready to help you figure it all out, and including having conversations with your clients if you don't feel comfortable delving into the details. So those links for all of that are in the chat, and Bitwise is happy to help you with all of it. We've got a lot of questions that folks have posted here, Matt. So let me start to run through some of these. Some of these questions are more fundamental about Ethereum before we have some of these questions regarding the products themselves. Brandon asks a really good one that is pretty fundamental. Do you consider ETH to be a primary coin or an altcoin, and why?
Oh, interesting. I consider it to be a primary coin because I think of the crypto market as having these two major categories: digital money and programmable smart contract platforms. And Bitcoin is the primary coin in the digital money space, and Ethereum is the primary coin in this other major application. Now, I do think they're very distinct, but they are the market leaders. When I think of altcoins, I think of coins that are challenging the market leader for their position. So they're coins like Solana or Cardano or Cosmos that are trying to outcompete Ethereum, and they're coins like XRP and Litecoin and Monero that are trying to outcompete Bitcoin. So it's a semantic definition, but I think of it as the two major use cases. If you're the leader, you're the primary, and then everyone else is an altcoin trying to disrupt you.
And in fact, some of them are being built on Ethereum.
That is true. Yes, some of them are being built on Ethereum and trying to shave off. It's just like the software industry, Rick. They're giant firms that dominate the space. Then they're interesting startups that try to do new things. Many of those startups fail and a few succeed. Same thing will be true in crypto. It's true in any technology area.
Timothy asks, for a growth investor, what percentage would you suggest crypto be as part of their portfolio?
Yeah, of course, we can't make any specific recommendation for people, but we can talk about what we've seen in our studies. Historically, if you add 1, 2, 3, 4, 5% crypto to a portfolio and you rebalance regularly, it has a phenomenal impact on your absolute and your risk-adjusted returns. Historically, it's significantly increased your Sharpe ratio, added returns without substantially increasing your volatility. But if something different happens when you go above 5%, crypto becomes the primary driver of maximum drawdowns in your portfolio, and you start to see increasing levels of volatility. So I think up to 5%, many investors will be comfortable. Above 5%, you have to really be willing to take on that added volatility. But of course, every investor is different, and past performance is no guarantee of future returns. But that's what the data would show you if you looked at it.
Earlier, we talked about the fact that so many big companies are engaging with Ethereum, using it in one way or another in their businesses. Here's an interesting question. Does the Ethereum network offer any value for the credit card companies, Visa and MasterCard?
Well, it does two things. One, it challenges the enormous rents that they apply on everything that we buy. I think most Americans don't realize it, but anytime you go to a store, the price is 2, 3, 4, 5% higher, because the merchant doesn't know what exactly they'll have to pay to the credit card company to process that swipe. And as the old saying goes, your margin is my opportunity. I think that margin is crypto's opportunity, and the rise of Ethereum and stablecoins will bring that down. But the flip side of it is, if you are a payments-oriented company and you recognize this, you can get ahead of your peers and build a competitive advantage and monetize the customer base that you can grow using that technology. So I'd note that Visa in the last few months just engaged in a program built on the Solana blockchain, actually an Ethereum competitor, to accelerate payments. So mostly I think of crypto as a threat to credit card companies, but like any technology, the ones that get on the right side, that don't close their eyes and shut their mouth and cover their ears, will see an opportunity to build new things on it as well.
And I think it's fair to say that the biggest companies in the financial services industry are not going to fall asleep at this. These are some of the brightest people with some of the deepest pockets and greatest experience, and they're not going to ignore the technological opportunities that this new distributed ledger tech offers. So we've seen a lot of announcements from MasterCard and from Visa on a global basis, where they're doing a lot of innovative things to take advantage of what this tech offers. So yeah, I think you're right. There's a big vulnerability there, and they're going to be determined not to become obsolete. They don't want to be the next Blockbuster in a world of Netflix.
That is right. Yeah, good analogy.
And that's all going to be good for the investor. It's going to be good for the consumer. So everybody's going to win. So I think it's really strong. Robert asks a question about BITC. He wants to know, how much Bitcoin would a client own if they were to buy 100 shares of BITC?
Yeah, they would have 100% exposure to Bitcoin effectively. So it invests in futures. They wouldn't own the Bitcoin directly, but they'd have notional exposure equivalent to the amount they invested in. So I don't remember the share price. If it was $20, that would be a $2,000 investment. They would have $2,000 of notional exposure to Bitcoin. It is 1-for-1 in that sense.
Russell asks, does the client need a crypto wallet to hold the ETFs?
No, these are just regular ETFs. They fit into your brokerage account just like SPY or GLD or EEM.
And that's the great thing about this. Similarly, it's just a 1099 as part of the brokerage statement, no K1. So this is about as simple and clean and easy and familiar as it gets for both the advisor and the client. So I think that's a couple of big advantages. And along those lines, Brandon asks about the tax consequences of holding these in taxable accounts. It's just a 1099, right?
Yeah, we of course can't offer specific tax advice, but if you look in our prospectus, you'll see the tax issues laid out clearly.
And he also asks if these ETFs are available in IRAs. For sure, right?
I think ETFs are just broadly available through the brokerage window, as long as you have brokerage access.
You know, these kinds of questions, I get them a lot, and it's because people are focusing predominantly on the word crypto and not on the phrase ETF. These are just ETFs. The fact that they're buying crypto futures is secondary.
That's the beautiful thing. That's why we worked so hard to bring these to market, because it does make it easy. As you've said, it just works like any other ETF.
Robert wants to know, it's a different Robert, wants to know the future, both the current and the future allocation of BITW. Bitcoin and Ethereum, the two largest crypto assets, are the number 1 and number 2 holdings of BITW.
That's right.
What do you see coming for the future?
Yeah, they're the dramatic majority of BITW. Of course, it's a market cap weighted portfolio, so we built it that way in case most of the value accrues to Bitcoin and Ethereum. The fund can reflect that. My personal view is that over time, we'll see Bitcoin and ETH be the dominant sources of market cap in the space, but that we will see more and more smaller blockchains join their share of the pie. Again, I make the analogy to the software space, where there's Microsoft and there's Oracle and there's Salesforce, but there's also Snowflake. And I think there'll be the snowflakes in the crypto world as well that emerge and become really substantial. Maybe not Microsoft, but still incredible investment opportunities. So I'd expect that to diversify over time.
Aiden is curious about whether you expect Bitwise to offer a stablecoin ETF or the like.
Interesting.
Working on that?
Well, stablecoins just reflect the value of $1, and actually they can't even accrue interest in the way a money market fund does. I'm personally excited about the stablecoin market. I think it will balloon in use. I don't mean to be, product pushing. I would push you back toward thinking about Ethereum. The reality is most stablecoins are issued on the Ethereum blockchain. So rising interest in stablecoins actually benefits Ethereum. It's probably the easiest way to get exposure to the exciting things in the stablecoin space outside of investing in private securities of companies like Circle.
Yeah, and I would add to that, let's focus on the fact that we're buying these digital assets for their profit potential. We're buying them because we think they're going to grow in value at a rate faster than other asset classes, while offering correlation benefits and so on to the MPT concepts. a stable coin at the end of the day, like you said, is kind of like a zero interest money market fund. That's not quite the same point. Not to say that stable coins don't have a great use case in the world, they do, but that's not really the focus of buying crypto or adding it as an allocation. I'll also, having said that, there is a tokenized money market fund on the market by Franklin Templeton.
Yep.
And that is the first such tokenized ETF. And I wouldn't be at all surprised if in years to come, we're going to see lots of tokenized ETFs, and Bitwise, I'm sure, will be in that fray.
Yeah, you may be right.
One of our attendees says, you mentioned metaverse, but are NFTs dead since their values are down like 95%?
Interesting question. I mean, I think it's important to separate NFTs as a technology platform from Bored Apes and digital rocks. So NFTs are just a technology platform that lets you have digital property rights. And I think it's one of the biggest ideas I've ever encountered. The idea of taking digital property and putting it into a vehicle that I can own, I think will have ramifications for the next 50 years. Bored Apes, I don't know if they'll have ramifications for the next 50 years. I think some of the early NFT projects may have cultural, historical, and art value. I think some of the generative art projects from folks like Tyler Hobbs are interesting. But I do think that PFP boom was just sort of a classic boom, and most of what will come out of it is rubble. But NFTs are massive. I mean, you know, we talked about it earlier. Nike doing $200 million in digital goods revenues. Those are just NFTs, right? We're calling them digital goods because it makes it sound better, but they're actually just NFTs that you can use in the real world. So I think NFTs are massive. PFPs, cultural interest, artistic interest, but yeah, the bloom has come off the rose.
Yeah, I mean, when we look at Starbucks managing its massive loyalty rewards program and distributing those rewards as NFTs, this is a huge value to the company and a benefit to its customers. So NFTs are a technology, and we're going to be NFTing everything. The deed to your house will be an NFT one day. Your driver's license and passport will be NFTs. Your education records, your employment records, your medical records, they'll all be NFTs. So I think that this is why the metaverse is so exciting and why NFTs will play a huge role in the metaverse. The fact that, as you said, Bored Apes are perhaps a Beanie Baby fad is not really relevant to the conversation.
That's right. Yep.
John is asking about BITW's discount. What is it going to take to change that discount?
Yeah, of course, important to note, we don't control the discount. It's set by the market demand between shares available and interested buyers. It can go up, down, and sideways. What we've said at Bitwise is we intend to convert BITW into an ETF as soon as the SEC allows us to do so, but we don't know when or if that will happen. So converting to an ETF would, of course, be extremely helpful in mitigating that premium. But again, we don't know when or if that will happen. Until then, that premium or discount is set by the market and market demand.
Russell's confused, and it's our fault, Matt. He says that you said that Bitwise ETFs are regulated ETFs, but crypto is not regulated, but ETFs are.
Spot crypto markets are not regulated at the same level as traditional stock markets, but futures are regulated by the CFTC. So the CME, which is the same exchange that trades S&P 500 futures and oil futures and all the largest institutions in the world, launched Bitcoin and Ethereum futures, and those are regulated futures, and then they're packaged into an ETF, which is regulated by the SEC. So even though the spot market is not regulated like the stock market, these futures and ETFs are regulated like other futures and ETFs and provide the protections of the 1940 Act and associated protections.
We have a question from a member of the media who notes that at a recent webinar, Matt, I said that I thought that Bitcoin would hit $150,000 by 2025, summer 25, I said, and you agreed with me. She wants to know if we still stand by that prediction and also what we believe our price prediction is now for Ethereum. So I'll go first. Yes, I stand by the prediction at 150,000 by summer of 25. That's roughly a 5x increase to today's price. And I'll say that I would expect Ethereum's price to grow proportionately.
Yeah, I like those answers. Everything I'm seeing in the market tells me that we're in the early stages of a major bull market. I see that in the prices, which are up substantially this year. I see that in the big firms coming into the space, whether it's BlackRock or Deutsche Bank or UBS or who name you. I see it in the SEC approving Ethereum ETFs and blended Bitcoin Ethereum ETFs. So I think we are in this bull market. I think your price targets feel accurate to me, Rick. I think we're actually pretty aligned.
And the good news is that if we're wrong by 50%, we've still tripled our money.
Yes, that is right.
So there are a lot more questions. We're running out of time. This has been fabulous information. I want to say thanks to Matt Hougan, the CIO of Bitwise. You've got the links to Matt, the Bitwise team, the new funds they've launched in the chat. I encourage you to talk to them and explore how you may consider integrating this into client portfolios. I also want to remind you that this is just the latest conversation in the fast-growing field of digital assets. And I encourage you to learn more about it. If you thought this content was a lot, you really ought to get your CBDA designation, certified in blockchain and digital assets, which is listed in the FINRA professional designation database. The certificate in blockchain digital assets is an online self-study course, world-class faculty. You'll get up to 18 CE credits. First half of the course is all about the tech. The second half, all about practice management. We have 5 different tracks. If you're a financial advisor, a financial executive working in management, if you're in the crypto field, if you're an investor, we're about to launch a new ex-US track for foreign professionals. We have folks from 37 countries who have already gone through our program. Matt, you run everybody at Bitwise through our certificate program, and we're really excited about that. And our new ex-US course is now, when we launch it next week, it's going to be available in 9 languages worldwide for folks around the globe. So I encourage you to contact us at dacfp.com and get enrolled so you can brag to your clients that you've got the knowledge they need for your help to them in the field of digital assets. Matt Hougan, CIO of Bitwise, thanks so much for joining us, and we look forward to talking with you again soon. Thanks, everybody.
Thanks for having me, Rick.